Alright, so earlier I posted a Tesla chart to Twitter, and it just showed a consolidation box from about 900 up here into 950. And VinCat asks, how do you trade these? If they break up or down and you take an entry, it'll be a late entry. Plus, there's a need to pay extra premium. So let's go through this a little bit. First off, I think that we need to clarify how something breaks out of a consolidation pattern and what is a proper entry and what is not a proper entry, at least in my book. So for Tesla here, let's just go ahead and stretch it out. So here we see Tesla is ranging generally every day to every other day through the entire range from 900 up here into 950. What we would want to see for a consolidation, let's just say, for example, break down because there's less volume down here than up here. So we would want to watch price press against this point into 900, into 898 and a half, and then there'll be a gradual break under this price. And it's that gradual break under price on a shorter term, and then it'll come back up to this 898 to 900. And then it'll test it. And then that's your entry short, is on that 898 to 900 test from underneath. And then you have a very small risk there. Say you take an entry at 895 and you put your stop at 900 just above the 23.6. So you've limited your risk to a very small portion. But what you don't want to do is see price trading. Say tomorrow price trades Tesla into 951 again, and then Monday price goes from 951 all the way down to 900 and then breaks down. What you're seeing there is a release of energy that you don't want to see at that particular point. We want to see the energy release once it breaks out of the box. Right now, what we're seeing is energy releases within the box, and it's just a very push-pull. And what's happening is we're developing volume within this area, and the more volume that develops, the more back and forth and choppy this is going to get, and the more you risk losing profit if you're trying to play directionally within this box. Now, what I would do, how I would trade this is I would put this in an iron condor. I would sell an iron condor and kind of trap this range. And when you sell an iron condor, what it does is you collect decay through the process of time. And so, for example, let's just set something up. We already have the retracements drawn. This is what I had on earlier. We know that above price, there are three retracements at 951, 964, and 974. These are all very major retracements, a primary, a secondary, and a tertiary level. And so we assume that price isn't going to just break across all three of these resistances at once. And then furthermore, we have this previous high up here at 987.69. So this caps our top side. We would say that we would sell an iron condor. We would want price to stay contained under 987, 988, 988. To the lower side, once price made this low down here on the 28th of January, we know what the tertiary retracements are, the yellow retracements are. And so we know the 23.6 here is at 898.56. And then once we test into resistance, we can go ahead and add one more retracement from the low, and we'll put it up here into this candle on the 1st of February, just as the first initial test of resistance. And so now we see that the shorter term level that we just drew in green, that 38.2 is right here at 885.75. So we have a couple solid support levels here within range, and there's still volume here at the lower end of this node that it's kind of caught into. Furthermore, we can go ahead and we see this extension candle here, this bottoming tail hammer. And what this candle shows is a lot of support, a lot of demand versus supply within this range. So let's go ahead and put a line there too, because we know that the last time price tested down here, it was bought. And so now we have a range that we can safely say price should stay within. That's 886 up here into 987. So let's just go ahead and put a box around that real quick. Then I'm just going to go ahead and shrink this over. So now we know that this is the box that we believe price will stay within. And what we're going to do now is we're going to sell to open an iron condor. And what that's going to do for us is it's going to give us a credit for selling the position to open. And so let's go ahead and we will go over into Thinkorswim real quick. And so we have Tesla. We're in the Iron Condors. And again, the spread we're looking for is eight. Let's call it an 885 to 990. So we can go to the 885. Um, so you see the bottom here, it's 885, 880, 885. And so what this is saying is on the very low end, what we want price to do for our maximum profit is stay above 885. And that's right here at that secondary retracement. Now the leg below it, that is 880, is our break-even leg. So if price were to close in between 880 and 885, there would be a part of a profit, but it wouldn't be the maximum profit. And so that's the low end of the trade. And then on the high end, like we said, this is 987. And so let's just call it 990. And so 990 is going to be what we want price to stay under. And so that is going to be the upside leg. So we'll do 990, and then it's a 5 point wide, just like we did down here. So it would be a 995. And you can make those wings different sizes. For example, if I wanted to do, I could do an 885, 875, and then make it 10 wide up top too. And what that'll do is it'll increase the cost of the position a little bit, but it gives you a little bit more leeway. So anyway, we come into this iron condor that we've set up, this 885 to 895, and we're going to go ahead and hit sell. And we can right click on this and actually look at it to see what that looks like. Let me close this one that I had already played with. There we go. Okay, and so now you see that this is for this expiry, so that's tomorrow. Really not what we're looking for. We see that the maximum potential reward for this trade, and that's going to be down here in the bottom corner that you'll see, is 123 max profit, where the loss on this is 377. It's because there's just no time. Iron Condors work through the collection of decay through time. So let's go ahead and turn it on for next week, for example, and we'll unlock this to see the current price. And this looks a little bit more structured. It almost looks like a one-to-one. We can see here that the potential max profit is 237 and potential max loss is 263. So not quite a one-to-one. But what this trade is saying is that we believe that through or into next Friday, Tesla's price will remain within that box that we've drawn. All right, and for taking on the risk of selling to open, even though it's contained risk because of the max loss, but we are given a credit in this position. It would be $2.37 per spread, and as time decays and price remains within that window that has been set, then you can see that profit starts to build through that decay. So here, as another example, if we thought that Tesla would consolidate through the 18th of March, oopsie daisy, it's not traded. The 25th of February instead, you see that the credit's a little bit bigger. It's 285, and then the max loss is 215 per spread, and that's because the more time that you hold this position, the less the probability that the stock will remain within that range. So if you made this out to April, for example, it would be a very large credit because it's a very small chance that Tesla would stay remaining between 880 and 990 through that period of time. So what do we do with this? So there's a couple of ideas that I use. The first idea here is that we open a shorter term Tesla Iron Condor. Let's go ahead and just put it back to the 18th of February. It was 237. It's not quite a one-to-one, but what we're trying to do is just collect all of this decay that's above the zero line. So let's go ahead and we would put this spread on. We'll say it's for a 237 credit. And then what we can consider is where to take entry directionally out of this consolidation break. Because we know that once this breaks, there's going to be generally half the people in this box are going to be wrong. If we break down, the long side is going to have to cover the short, and the shorts are going to continue to add to their position to average up. And we'll see that price break down. There's a gap here, and then we have the 61.8 at this 850 area. And so how do we enter, let's say, a put position? Well, we are contained in here and we're making money while price stays in this box. And so what we would look for is a breakdown of the 885 level, and then there's a potential to enter a longer term uh, put position or a bear put position. And also, if you wanted to take the risk on, you could also enter like a bear put or a vertical within the box, looking for the breakdown. But it needs to be a longer dated uh, trade than an iron condor than the iron condor you put on. So, for example, if we put on the iron condor for 18 Feb, we may consider something like a 850, 808 on Tesla as a bear put for that breakdown. But I think the important thing to remember is that look at how much decay is being collected by the iron condor. Um, and this isn't going to be how it works every time, but if we know that we have a 237 credit and we know that this expires in 8 days, just we can very crude math this and we can divide by 8, and we notice that we get about a decay rate of 30 cents per day per spread. And so if we're collecting 30 cents per day per spread, and this isn't actually how decay occurs. Decay is not linear. Um, decay is decay is exponential. And so as expiry nears, decay and theta increase in speed by time. And as we draw near the expiry, theta approaches 1 while delta approaches 0. But anyway, so let's just say hypothetically, because this is a short enough time period that this isn't going to be too far off. And so let's say that this spread is collecting 30 cents a day per spread open. We could go into Tesla and we could say we want to open a bear put in Tesla, and our range that we were looking for is we want to collect below 885, and we want to test into at least 850, right? So let's target 850. Let's do an 850, 855, right? And that'll close this gap. So we can do an 850, 855. Oh, this is the wrong month. So we go one more out, 850, 855. And these are $1.33. And we can also note that the theta of the position is just about $2 a day. And then the delta is about $1.50 a day. So if the stock didn't move at all, the bull call spread that we would purchase, or bear put spread that we would purchase, would lose around $2 a day. Whereas the iron condor is collecting 30 cents a day. And so you see that even though we've entered into a bearish position here with this bear put spread dated for 25 Feb, the shorter term iron condor is collecting more decay than this position is losing. And so you are actually making $28 if you bought one of these 850, 855 bear puts and you bought one of the iron condors we covered, then you would be actually net making $28 per pairing of the two. And so while price is still remaining within the box, you're collecting the decay and the bearish position that you've opened while losing capital within that position, you're making well enough to cover it. It's important to remember that not all trades that are opened for the purpose of profit. Um, if you want to hedge positions, I mean, hedges are opened to to lose on purpose, almost just to protect capital. So it's important to remember that you can combine different spread strategies to achieve your goal, and make it through these types of setups. There's no reason to you know risk capital within chop. And so this is a way out of that. So this is certainly how I would set it up. You could set it up the long side too, keep the same iron condor, and you could use the same theory. We would think that on the break of this, if all of these three retracements were held, we would see a move up into the point of control or the 61.8 of the tertiary, and that's 45 to 70. And so we could do the same idea. Um, we could do a what was that? Break 975. Oh, a 1045 to 1075. So we do like a 1030, 1040, and it would be on the other side. So let's see here. Of course, I don't have no strikes. There we go. And so we'll do a 1030, 1040, or yeah, 1030, 1040 is fine. Yeah, let's just do the 1030, 1035 because I can't display the theta elsewise. So if we do the 1030, 1035, same general idea. This one's decaying at 3 cents per day, with a delta losing less than a penny. So we would be losing 3 cents, but the iron condor would be making 30 cents. So in this regard, it would be 27 cents profit per day, depending if you took this pairing, if you took the bull call pairing out of the money, and you took the iron condor, sell to open iron condor. And with the iron condor, I think the last thing I need to note is you can close that at any time. If we hypothetically open the iron condor at 237, and in 4 days time this is decayed to $1, there's no problem with you can just buy to close the position. And what you would do is, if say the credit was $1, you would just literally um, buy to open it at $1, and then you would make the $1.37 on each of the iron condors. So anyway, that's me rambling about how you can play breaking out of consolidation or consolidation itself. I hope that it helped and it didn't raise more questions than answers. But if you do have more questions, feel free to reach out.